Good morning, my name is Steve Janz and welcome to my YouTube series. What we're going to go over this morning is share compensation. You've had a chance to take a look at Sleepy Corporation and hopefully work through the problem, look at some of the journal entries with the solution, and hopefully this video will help clear any misunderstanding that you have on this topic. Now, I've taught this topic over the years and sometimes I'm a little surprised at how many students struggle with the first few journal entries. And I want to use this video to help clear any problems that you may have so that when you see this problem on a quiz or on the final, you'll get 100%. Let's get started. So the first thing to do is, as I mentioned in class, with Intermediate Financial Accounting 2, or also known as FA3, it's so critical that we read the question carefully and slowly. And again, highlight, underline the key information. Now, as you go through this question, there's data and there's information. Data is just there, but we don't need it. Information, we need to figure out what is the information we need to use to solve this question. And that's part of the challenge. That's part of the expertise that we're developing here with you and your skills. Let's get started. You've had a chance to look at the question, and let me identify the key areas of the question first before we start looking at how to do the journal entries. So the key thing to understand right off the bat is that the executives have been granted 200 options. So we've got 200 options that have been granted to the executives. Now, each of these options, each one gives the managers the option to purchase 200 shares. So we have to recognize that 200 options times 200 shares, there is the potential for 40,000 shares to be purchased here. That's key, and that's key to read that. So a lot of people will only think of 200 options. They won't look at 200 times 200. That's key in this question. So let's get started. We'll start with the first timing amount, the first journal entries, and I'll walk you through how to solve this. So right off the bat, this is granted on February 1st, 2015. Now, what has to happen is that the executives, the managers, the options vest February 1st, 2017. 2 years that these options invest. So we have to recognize this expense over a 24-month period. Now in the question, it tells us using an option pricing model that we come up with an estimate of what these options are worth. And that's $150,000. So the key thing to recognize is that we have to take that $150,000 over 24 months. So think of it as months, not years anymore, because we're dealing with fractions of a year. And this is what a lot of students struggle with, is that we have to do entries over these first period of time, these first couple years. We've got to do journal entries for that, and we have to think of it as months. So right off the bat, February 1st, 2015, there's no entry required. These are when the options are given to the management team. Now, over these 2 years, we have to recognize this expense. So we've got a December 31st year end. Well, how many months, and again, think of this as months, do we have so far? And again, what's the secret that I always talk about? These guys. Use your fingers and calculate how many months have gone by in 2015. Well, February 1st to the end of December, that is 11 months. So our calculation is 11 over 24 times 150,000. That'll equal 68,750. So there's the first key thing, is that we have to recognize an expense here, a compensation expense for the first 11 months. So we're going to have our first entry, compensation expense, $68,750, and the credit will be contributed surplus stock options, $68,750. Now, that's 11 months. We still have a number of months that we have to do. We still have 13 more months that we have to account for. So in 2006, we've got to do another entry. This will be for 12 months, a full year. So 12 out of 24 times 150,000, that's equal to 75,000. So that'll be compensation expense, 75,000, and again, contributed surplus stock options, 75,000. Now, we've accounted for 23 months, but we need to account for 24. So in 2017, we still need to do another entry. So we need to do another entry for 2017. So going over here, we're going to take a look now at 1 out of 24 months times 150,000. That'll be equal to 6,250. So we're going to have December 31st, 2017. We will have compensation expense, 6,250, and we will have contributed surplus stock options, 6,250. Now, that's the first part of our solution. This is recognizing the expense, the $150,000 estimated expense, over the 2-year vesting period. That's the first starting point. Now what we need to do is we need to look at, once they've been vested, will any of these options be exercised? And if they are exercised, how do we do the entries? Because remember, we're going to receive the money from these executives, and in return, we're going to give them shares. So you can see on December 31st, 2017, 125 options are exercised. So right off the bat, we've got 125 options. Now we know that 125 options times 200 is the amount of shares that we're going to be giving out. So that's equal to 25,000 shares. Now, what is the price that the managers must pay to us? Well, the option price is $45 a share. So 25,000 times $45 is equal to 1,125,000. Now this is the start of our entry. This is how much cash we're going to receive from the managers exercising these options. So our starting point here is cash, 1,125,000. Now, what do we have to do? Well, if you take a look here, we've created a contributed surplus stock option account. And over those 24 months, we've got $150,000 into that account. Now, because some of these options are being exercised, we need to reduce this account and give that money or attribute that money to our common share value. So how do we do that calculation? Well, we've got $150,000 times 125 out of the 200 options being exercised. So 150,000 times 125 divided by 200 tells us that we've got to attribute $93,750 out of our contributed surplus. And we have to attribute that to our common shares. So when we put this together, we are going to have debit cash, 1,125,000, contributed surplus stock options, 93,750 on the debit side. Add those together, that's the amount that we're going to give to our common shares and attribute to that. That'll be 1,218,750. Now, our last entry. What happens when these options expire? And if no one exercises any more, we're still going to have this balance in our contributed surplus stock option account. Well, we need to take that balance down to zero because they've expired. Well, we started with 150,000. We basically debited out 93,750. So our remaining balance then is 56,250. So in December 31st, 2019, this has expired if we're doing year-end adjusting entries. So our final entry will basically be to take this account, this stock options account, and show it as expired. So contributed surplus, stock option, the remaining balance, 56,250. We're going to take it out so that everything will come down to zero, and we're going to create a new account. We're going to call it contributed surplus expired. And that's key. Expired stock options, 56,250. So we basically will show that these options are no longer active on our balance sheet. So I hope this helps, and I hope to see a lot of 100% answers on your next quiz or final related to this topic. Have a good day.